want to greet? Say good morning, good afternoon, good evening. Go ahead, put your video on. Let us see your faces. And then we'll get started.
Hi, Ivan. How are you?
Hey, buon après-midi, monsieur.
Clementi.
Bon après-midi.
Greetings, Dr. Gaga.
Hey, Brother Moses, how are
Good
you?
to see you, Moses.
I'm fine. Auntie Renita, greetings.
Auntie Renita, everyone, good afternoon.
Good afternoon. Good afternoon.
A young student with us today.
Yeah, there's a young student in the house.
Yeah.
I like your background.
Good afternoon, everyone.
Hi, Dr. Phil.
Greetings, Kaiser Fred.
Bishop Moses, Elder Johnson.
Greetings, sir.
You're always smiling, Elder Johnson. Smile to
Grandma
laughter
Grace.
now.
Grandma Grace, you may need to write a book about
Kaiser Fred,
raising
where is
grandchildren.
Albert son? I'm looking for him. Hey, he's here. He's here. But he's on mute. Yeah. Greetings, Albert son. Unmute yourself.
Yeah, I'm online. I've been seeing you when putting on your t-shirt.
And not to mention,
Thank you.
you can't see your photo.
Hey.
Hi.
Greetings, Auntie Grace and the Granny.
Yeah, greetings to you.
Auntie Grace.
Wow.
Yeah,
Bishop
I'm
Harry.
showing off.
Hi, how are you?
My grand.
Greetings, Kwamada. I can see smiling Kwamada.
For greeting and then she will go away.
Albert Sonny, can you unmute your photo, your video? We want to see his picture.
We talked about having the children, Grace, but I don't know if,
Hey, yes, sir. There you go. Good. At least your face is visible.
All right. Well, good morning, good afternoon, good evening. You are all welcome back here on this Thursday to move into our next session. And it's so good to see everybody and on time. And one of the things we've been praying about during our time in our DML prayer times is about the youth and encouraging them to also speak into our lives as well. And so Grace is taking that very seriously, and we're starting with a 1-year-old here with us today, so that's great. But we do welcome you, and today we are looking at sessions 7 and sessions 8. And last week we got started on session 6 with pricing and cost analysis. And oh, there we go. We have another young one with us there. That's great. And session 7 and session 8 are 6, 7, and 8 are the 3 that look at the money management portions, at the bookkeeping portions. These are also often the more challenging courses to teach. And so you will have me teaching all 3 of these. Surprisingly, none of our trainers signed up to do these ones, often because it's just not favored for people to teach. Again, you can have accountants teach this, but it's difficult for accountants to speak in a way that breaks it down simply for somebody who has actual fear about math, fear about numbers. And so that's the challenge, is we need to get ourselves to a comfortable level, even though we're not accountants. And so I'm not an accountant. My father taught me money management, though, from the time I was very small. And so it's something that I've grown into over time, but it is, for trainers, it's not an easy one to do. So let me share my screen, and we're going to get started for today. One thing I want to make sure that I have is the French. Yes, there we go. And so one of the things that I think we are seeing is more and more quizzes that are coming in. So you are doing well with those. I'm paying attention to those questions that are problematic. I'm learning as well about Google Classroom and this quiz function that Google cannot grade the quizzes as much as I thought they could if I told them the right answer. So some of you are seeing lower grades than what you should, and it's because I have to go in and manually do that. So if you get an automatic grade when you take a quiz, don't fret about it if it is low. I have to probably get in. I get in every 24 hours and I grade everything that's there and update it. And so then I'm assuming you can get in to see what your adjusted grade is. Whether you get a notification on that, I'm not sure. But that is my goal, to do that every 24 hours and then do the updates for that. Some of you have been having issues, I think, getting into quiz number 9. I'm not sure why that is. It's the same as the other ones. So feel free to email me if you have any challenges. But I've been very pleased with the number of views that we're seeing of the videos, as well as the quizzes coming in. So thank you. So we want to start session 7, where we're talking about money management. And we want to take a look specifically at what the Bible says about money. And sometimes we spiritualize and dichotomize, actually, between what is a spiritual issue, matters of the heart and matters of the mind, and we forget that the economy, that money is something that God cares about. Proverbs 13 verse 11 says this: "Dishonest money dwindles away, but he who gathers money little by little makes it grow." And this is something that we believe that we need to be hearing more about in our preaching and our teaching, is the patience to have money grow little by little is a challenge. We like to have everybody, especially the youth, want to have the job that gives the get rich quick. But that is a challenge for us to manage. And so it often, when it comes quickly, it may also disappear quickly. There are statistics on those who win the lottery, that 4 out of 5 of them will be bankrupt in a number of years. And so little by little is really the way that we were designed to be able to manage and to grow into that. Proverbs 11 verse 1 says, "A false balance is an abomination to the Lord, but a just weight is his delight." And that word abomination is so strong. And I know that in many places where people are living hand to mouth, struggling for survival, that temptation to have the false balance is very real. And yet God isn't kidding with these words when he says it's an abomination and the just weight is his delight. And these are things, again, that we need to remind ourselves that God cares about these details as well. One of my favorite passages is Proverbs 30 verse 8, which says, "Keep falsehood and lies far from me. Give me neither poverty nor riches, but give me only my daily bread." And it goes on to say that if I am poor, I may be tempted to steal. And if I am rich, I will be tempted to forget about God. And so oftentimes we need to consider the fact that most of us have been given grace to manage an amount that we are able to manage without getting into those temptations. Many people pray for wealth and for riches. And yet it's something that it's a very difficult temptation to manage. And so most of us need to be content with having our daily bread and be able to manage that in a way that glorifies God. Matthew 6:24 says, "No one can serve 2 masters, Either he will hate the one and love the other, or he will be devoted to the one and despise the other. You cannot serve God and money. And this is something that we want to reinforce in our class. One of the things that we teach throughout is the purpose for business, that the purpose for business is not profit. The purpose for business is to help people flourish, to take the resources that God has given, mix it in with our gifts and our talents and our time, and be able to present it as an offering to creation and to the world as a blessing. Now, we need profit in order to achieve that. So profit is a means to an end, but it's not the end in and of itself. And that is what Matthew 6, verse 24 is reminding us. If God is our end, if helping to achieve the kingdom of heaven on earth is our goal, and by doing that, we are doing business to help the world flourish, then we keep God on the throne. But when we say that profit is our goal, which is what many, many business people believe, then it takes God off the throne, and suddenly the way we get our profit doesn't matter. How the customer fares doesn't matter. How the employee, whether the employee is flourishing, doesn't matter. And so we're reminded here, we cannot serve two masters. And this is critically important for business people, Christian business people, to understand where profit fits into that mix. Did you know this? Did you know that Jesus spoke more about money than heaven and hell combined? This is something that we don't think about when we think of Jesus. Jesus was a businessman, right? For 18 years. He understood the temptations of probably profit over ministry. He was tempted in every way. His father died at a younger age. He had younger brothers and sisters. He was the oldest son. He knew the challenge of putting food on the table and doing business in a way that was being honest. And he spoke about money, more about money than heaven and hell combined. Did you know that 1 out of 7 verses in the New Testament is about money? I haven't actually done the counting. This is a statistics I read about, but that is pretty significant. Did you know that there are 500 verses on prayer in the Bible, 500 verses on faith, and nearly 2,000 verses on money? And we want to emphasize this is not a coincidence. God cares about our perspective on this, and he offers us commands, wisdom, advice, and direction on how to stay healthy, happy, and content as it relates to our brief time on earth in terms of our interaction with material things. And that's the rub, right? So here we are saying God gives us commands, wisdom, and advice, not so that we're poor, not so that we don't have any money, but so that we can stay healthy, happy, and content. And so most of us, we need to pray, as Jesus prayed, to give us our daily bread, that we may be content with that and not enter into the temptation of having too much or having too little, which will cause other challenges. So the question we ask ourselves in this session is, what does it mean to do money management God's way? What does it mean to not do money management God's way? And what are the temptations that keep us from doing money management God's way? So I'm going to open us with a word of prayer, and then we will get into the session. Let's pray. Father, we thank you for your word, which is so relevant to our lives, teaching us how to manage money in a way not that will bring us wealth or will keep us poor, but that will give us happiness and the ability to be content. Father, we do ask you for our daily bread. Our desire is that we are able to flourish in this world, have our children and families flourish, but also to be part of helping others to flourish as well. Father, we pray that you keep us from the love of money, but Father, that we may continue to keep you on the throne, that we may desire to see growth in our businesses and growth in the profit so that we may help more people flourish, whether they are employees or customers. Father, we pray that as we go through this session and the next one, that whatever barriers we have in terms of math in high school or in elementary school, that we may put those aside and that we may embrace that you have a desire for us to be accountable, to be stewards of what you have given us, and that we may approach that stewardship with joy, but also with a sense of knowing that you are giving us peace in and through that. So for each person on this call and for those who are yet to join, Father, I ask that you bless them, that you give them ears to hear, that you keep distraction far from them in the rooms that they are in. Father, that you keep the network strong, that the ability to listen and to attend may be there so that we may learn to manage our money in the way that you would have us to. In your name we pray. Amen. So these are some of the questions now speaking to you as trainers that we want to take a look at. And this provides some good discussion. What does it mean to do money management God's way? What does it mean to not do it in God's way? And what are the temptations? And some of the temptations we've already discussed in our ethics session that Freeman led us through. The temptations to not give receipts or to give blank receipts, to ask for the person we're buying from to change the number on the receipt, to have dishonest weights when we are selling things, to have a lower quality, to speak about our product that it can do more than what we actually know it can do. And those are all the ways that ethics enters into our business. And money management is something that when we ask people what it is, and I'm going to go just slip this for a minute, slip past this and come back to it. When we look at the structure here of the building that we are constructing, we are now moving to the roof. So our windows have been framed, the door has been framed, and now we want to put the roof on. And many people, when we ask them, what kind of roof do they have? What are they doing for bookkeeping? Most people will say that they aren't really doing bookkeeping. In fact, some people have just very much said to me, I don't want to know, because if I know, then I will be so discouraged I will quit. And so many people say we do, especially with farming for some reason, people say we do it as a hobby. We know we're not making any money. It keeps us busy. And yet we have, I think, a responsibility. I think it's about stewardship of our time and our talents and our resources to be fruitful and multiply. We have an economic bottom line. We have a calling that God has given us to take the resources and to help to make them flourish for more people. And so as we look at the roof, many people end up saying they don't have a roof. They are trying to keep out of the sun. They are trying to protect things from the rain, but they aren't doing the bookkeeping. And so if we go back here, we want to see what our objectives are for this session. So the objectives for this session, the first one is to gain an appreciation for the need to do bookkeeping. And that's a tough one. Trainers, that one's not easy. The only way you can help people gain an appreciation is by making it simple enough for them to believe that they can start to try. Otherwise, what you will have often in your rooms is a lot of bodies and people nodding their head, and they may even have their eyes focused on you, but their minds are elsewhere, and they're just trying to get through these sessions. So our goal in the session, and session 8 as well, is to help people gain an appreciation for the need, to understand the importance of it, to ease fears about bookkeeping. Basically, it's addition and subtraction. And that's something I think we need to emphasize. And you don't have to even do the addition and subtraction yourself. Your calculator can do it. If you know how to use Excel, Excel can do it. In fact, I recommend that we not do it ourselves because we make too many mistakes. I love Excel for that reason. I can put the formula in there, and I can trust it to do the math. Whereas for me, if I'm using a calculator, I can put the wrong number in. And so we want to help ease fears in these sessions. But we do need to understand the financial planning process. There is a process that we need to go through if we want our business to grow. If we don't have a roof, our business can only grow so much. It will just not be able to thrive and flourish like we want it to. We have many people who say they do business without bookkeeping, but my guess is they're going to be a certain size business and they will not grow much beyond there, because you're just not able to do good financial management or make good decisions to help the business. You're not going to see the trends and so on. The next objective is to develop a method that can work for the person who is not doing the bookkeeping. And so for that, I mean, we are not looking for everybody to become an accountant, but they need to understand the method, that if they have a bookkeeper, that to understand what it is that they are being told. And so when we do the financial planning process, we're going to talk about financial management, and then also for the handling of the finances, but also what does it mean to be a manager? We're not doing necessarily the bookkeeping, but we need to understand what is being said. So we need to have a basic understanding of bookkeeping terms. And then for the slightly higher level group of participants, we're going to gain a beginning understanding of the basic accounting principle. Not everybody, if you're doing a micro business training, you will likely just do the simple cash journal that we're going to look at today. If you have a group that is slightly bigger, they're more the SMEs, we want you to begin to introduce them to the accounting equation, the basic accounting equation. And so we'll look at that today as well. And so our objective as well is to get people to start somewhere if they're not doing anything, or take a step forward if they're already doing something. All right, and so those are the objectives that we have. You can bring in somebody who can teach all the financial terms and procedures, but if they aren't able to couch it in a way that makes people feel safe, then it's going to be a great lecture, but there's not going to be a lot of engagement. Surveys that are done, and these are just some pieces of reality that we need to remind ourselves of, found that 58% of employees cheat on expense reports. If we aren't looking at these things, we are losing money without even knowing that we're losing money if we have employees. 50% of employees work a second job on company time. So they are being paid to work full-time for a business, but they're dividing their time and doing something else. So again, there's a lack of stewardship. And if you aren't paying attention to some of these things, it's a lack of stewardship on your part for not making sure that people have enough work to do, that they are earning what you are actually paying them. 36% of employees rush close deals through accounting before they were really closed. And so there is, again, a lack of a policy and an order, and we would say the internal controls necessary to make sure that a process is being followed so that, again, we have stewardship of our time and of our resources. 19% of employees give a kickback to a customer. So if you buy from me, or I will give you this. And sometimes that is done without the knowledge of the employer. And so there's a lot of issues that come into the bookkeeping, the building of the roof, both for ourselves as owners as well as for the employees. And that sets into the whole idea here that we need a system in place. There needs to be a system to how this roof functions. And that's one of the things we want to talk about. We want to remind you as trainers that review is important, that to take the opportunity to review every week to talk about what happened with your pricing and your cost analysis from last time. How many of you sat down and worked through the price of your product? Do you have to change your product? Your price, I mean. Are you able to change it? How are you going to deal with the challenge if you find out that your price is lower than what you need to survive? What happens when we find out that we're not actually doing a business, we're doing a benevolence. We're doing our business is more of a hobby because we're not making a profit at all. Those are some difficult things that you will find from week 6 to week 7 that you'll need to process with people. And sometimes we found that people shift their business midstream. And that's okay. It's about stewardship. Certainly we aren't calling for that to happen, but we need to make sure that we look at the 3 ways to make a profit. So I'm going to stop sharing for a minute. And I want you to tell me, have some of you unmute, what are the 3 ways that we can make a profit that we discussed last week? Anybody? Wycliffe, you're on mute.
Okay.
Yes, one way is by increasing price.
Okay, good. Increasing the price.
Cost, and the third one is.
Okay, I heard the one from you, so I'm going to go to Pastor Alex for the next one. Increasing the price, what's another way?
Increase sales.
Increase sales, great. And Fred, what's the third way?
Okay.
Fred?
Hello. By reducing costs.
Yeah, go ahead. What's the third way?
Reduce cost.
All right, so decreasing your expenses, right? Decreasing your costs. All right, so that's good. Thank you for that. You can mute again. And that's just important that we remember. It's important that we remember that there's only 3 ways to increase profit. And so if we are finding challenges, we need to look at those 3 things as well. All right. How many of us believe it's important to keep financial records? How many of us keep financial records? And I want you actually to have, I'm going to pause us to have a discussion about this. One of the things that we find when we teach this class, I will ask people to raise their hand. How many of us believe it's important to keep financial records? Everybody's hand goes up. How many of us keep financial records? Very few people put their hands up. And so I want us to have a discussion in small groups relating to why that is such a challenge. And from a biblical perspective, from a stewardship perspective, this isn't just, I don't like math. This isn't just, well, it is actually, we can talk about the reasons for that. But I want us to have a discussion as trainers. What is the disconnect, and how can you, as trainers, begin to impact, to get into people regarding the importance of this. So I'm going to send you into rooms, and I'm going to have to quickly pull out the French for a second, so just bear with me as I do this. All right, and I'm going to give you about 7 or 8 minutes because I want you to really discuss why it's difficult, but also as a trainer, what is the way forward? Because this is one area where we continue to see people say yes, and this is important, and we're giving tools, but probably less than half actually start to use it. And so how do we have a breakthrough to help people to do this? And maybe we need to continue to have more mentoring and coaching. And that's the other thing that we'll talk about more next week when we do some wrapping up as well. All right, you're almost ready to go here. Almost ready, sorry. Okay. There you go, off you go. All right, welcome back. All right, let's have some people share what you came up with. What are the challenges relating to bookkeeping? And how, as trainers, do we help people overcome some of these barriers? Who would like to start?
I will start. Ben?
Okay, is that Ben? Ben,
Yes.
go ahead. Okay.
Okay. In our class, we had a discussion on why is it, first of all, we look at why is it difficult for people to keep records.
Yes.
And one of the things we look at was there's a lack of knowledge, because a lot of people have knowledge about record keeping, and they don't know how important it is to their business. And one person also shared that it is a lack of experience because they don't know, and then fear of figures, putting figures together, maths. In record keeping, there are maths, and so a lot of people fear putting figures together. So those are some of the things that we look at as difficulties. And then we look at how important it is to the business. Record keeping, we say that it keeps track of the business, and it makes you know the status of your business, keep your profit, make you know what your profit is, your losses are, and it also helps you keep track of your supplies.
Okay.
Right.
Good.
So basically,
So a lot of the barriers as well as the importance for it. Let's see, Stephen.
Yes, in our group, we discussed on the issue of one, it is a cultural thing. Generally in the society, the issue of there is no culture of record keeping concerning various things. So even when it comes to business, they fail to keep record because it has not been a practice that is upheld right from upbringing and until people grow up. So even when they start a business, they find it hard to keep record. Then secondly, some people feel like record keeping is just for accountability. So they feel, if this is my own business, who am I going to account to? Who will ask me about what? And so it's my own business. I know what I'm buying and selling. I have nobody to account to. And so they don't care about keeping records. So as a way of improving, as we will train them, one of the things is to let the people know the importance of how records help you to see the status, as somebody said, and how profitable the venture is and how to improve, but also then to begin to devise ways of helping people start practice, and to kind of break it down and simplify it, how record keeping can be done, because they are not used to it, and we try to bring a simple way of how they can start. So that's what we discussed.
Thank you. And of course, we want to emphasize the theme that we are not owners of the business, we are managers. It's God's business. So the accountability is for him. Isaac Kawoya.
Yes, I'm coming from group 7, and most of the things have been said, but it is carelessness. People are just careless. And then the other point was what he said. I don't have to give an accountability. And then there is lack. We don't have a plan, a financial plan. We don't have budgets. Many of us operate without budgets. And these were personal. They were not, why people, but we said why we don't, we in the group. And then others, we are lazy. Laziness was another factor. And then, so the way forward is change the attitude that this is not our business. We are just managers, stewards. Yes, that is what we discussed.
Okay, thank you. Elvis.
Okay, I'm from group 9, and we discuss about, we focus more on how we can make people to actually value and practice record keeping, because it's a general problem, as Stephen was saying, because people think the business belongs to them, they don't need to be accountable to anybody, and the discipline of taking the records judiciously is not there because of laziness. And also, we said to make people to be committed to it, we have to educate them on the importance of record keeping to their business, for them to be able to understand the market, to be able to know which of the commodities they are selling is in higher demand in the market. And the bookkeeping will help them to be able to know what profit they are making from each of the items they are selling, the trends, whether the demand is increasing or it's reducing, and all of those things. So it will also help to know how you can fix a budget, your running costs for your business, your running costs for your home, your running costs for whatever thing you have to do. So when you keep records, it will help you to fix a good budget on how you can do it, so that your business at the end of the day is not affected. So those were the lines that we discussed.
Good, thank you. I'm looking for those now who have something different than what's already been said. Fred, you have your hand up?
Yeah, mine was group 5. And one of the reasons why we don't keep financial records is sometimes people feel too tired after, like, if you are attending to a shop, you have been working all day long, you say, I'll do that tomorrow, I'll do that the other day. And so you keep on postponing, and by the time you forget. Then another thing is laziness. Could be maybe you are too lazy, you cannot do it. After all, the business, you know the progress of the business. And then another thing is some people are too busy. You are doing a lot of things. After the business, maybe you have to attend to children, you have to do all the other stuff. And then lack, in our group, somebody said there's lack of discipline. Sometimes things we do, we have to discipline ourselves to do the things we do. You give yourself like 5 minutes after work and do it, but all of us don't really like to do things like that. Then we said, now, if we don't do bookkeeping, then our business is most likely to fail because we will not keep track of the records. We will not know how much we are spending, how much is coming in. So even when it is going down, you will not know that's going down. And another thing we fail to do if we don't keep records is that we cannot plan ahead. You will not think of maybe expanding your business because maybe too much money is coming in, you need to expand it. But because you are not keeping the records, you will not know that. And then we said, how do we encourage people to do bookkeeping? By making it as simple as possible.
Yeah.
Okay.
All right, good. Thank you. Grace, you have something to add? Last person yet?
Yes, in our group, we say that there is the level of education, which is a problem. There are some people who have not gone far, so they don't know how to keep record. And then also fearing taxes, to pay taxes. So would rather not record, otherwise the revenue authority, especially in Uganda, will come for us and they'll see how much money we are making. Then we said as a way forward, let's train people to use some simple terms. Like we avoid things like double entry, ledger, and other things, but just give them some simple terms, and also train people to appreciate record keeping. Thank you.
Good, that's excellent. You know, there's a lot of things in there that we need to consider. So one of the things I was hoping somebody would say is that the best thing that you can do to help other people embrace it is by doing it yourself. All right, can you hear me now?
No, it's okay.
Yes, we can hear you.
Yes,
Can hear
sure.
you.
Yes.
So the best the best teacher is one who is practicing themselves. And so if you are not running a business and you want to do this training, you need to have yourself on a budget, because when you are passionate about something and it's not information, but it's actually become transformation, it becomes easier to teach about it. So all of these things that you said are very real, very true. I tend to think that there's a lack of knowledge, more so than a laziness, a lack of knowledge of the value and the importance of it. This idea that it's my business, so I don't have to be accountable to anyone. We're forgetting that Scripture, of course, says we're accountable to God and to each other, as well as to the authorities, as well as to government. And those are things that we need to keep in mind when we start cheating and making shortcuts and justifying. Then we run into challenges in terms of God even helping to flourish our business when we are not doing the right thing. So there are many things that we want to be able to cover in this session, and the importance is when you are teaching this is to allow people to talk, to allow people to have this discussion and really get down to some of the realities. Some of you said the culture, and I think that that's a very important thing as well, that the culture has, that the culture says that the community is more important than the individual. In a warm culture, keeping records can feel like it's not, you're looking more at yourself. You're not keeping in mind the big picture. So these next few slides, we talk through what is the importance of record keeping. I'm not going to spend a lot of time looking at that. Makes you understand the inflow and the outflow. And really what we're trying to do here is just reinforce the importance. And so you've watched the video, I'm sure you've seen that. Lots and lots of reasons to keep records. And especially if we want our business to be able to grow. If you don't keep accurate records, you can't measure your business's progress. If you can't measure the progress, you can't manage it. And if you can't manage it, it won't succeed. And some of you said that to do a business without a roof is just, it may function for a while, maybe the rains will hold off, but it's going to run you into challenges. And many people will say, in fact, I've run this business for 10 years, I've never kept records. And that may be very true, but they also haven't grown probably to the potential that they could have had they been managing that. Records help us answer questions that every business person asks. Which of my products are most popular? What are the expenses associated with the goods that I sell? Have I earned more money than last month or last year? What is the, what does it look like month to month or year to year? Are there trends and patterns that record keeping allows me to see that can influence my decisions for how this business goes? So those are things that, again, if you're teaching the class, you want to take time to have some discussion about what do we miss when we elect not to do that. And I would say that there is a lack of discipline is also a big part of that. Saying I'm too busy, we'll talk about that as well. So say two primary excuses that people use. My business is so small that I know everything that's going on. And that's a false assumption. You can be aware of what is happening, but you will not have the big picture. Our mind is just not able to remember the income, the expenses from month to month, year to year, that will advise us in making the management decisions that we need to make. If we are looking at those, then we will probably remain small. And for some people, that's okay. They're doing this to put food on their table. They're not necessarily wanting to grow their business. And that's a reality. Not everybody would like their profit to grow. Not everybody necessarily wants their business to grow. And there's a big difference between those two. Excuse me. The second is that I'm just too busy to keep records. And being busy is actually an excuse. People love to say how busy they are. And we love to tell people that the reason we didn't get something done was because we were so busy. But it's really a lack of priorities. One of the things I often say is my pastor told us as a congregation that we were not allowed to tell him that we were too busy. And his message was, you are an adult, manage your schedule, manage your priorities. Let your yes be yes and your no be no. So I've learned to not use busyness as an excuse, because as soon as I say I'm too busy, it's a reflection of me. It's a reflection of me not managing my schedule and not managing my time. And when it comes to running a business, I believe our message to our participants is that this isn't an option. It shouldn't be an option, not when it comes to stewardship. This is something that we are called upon to do if we are going to fulfill the call of Genesis 1:28 to be fruitful and to multiply. We have to be able to show that we are doing that and to understand when we are not doing that. And that's why the pricing and the cost analysis class is the first hint to some people that they aren't breaking even, that their price does not cover their overall costs. And that is why they are needing injections of capital from time to time, not because they are necessarily eating it, although that's a big challenge, but also because they haven't done the bookkeeping work to really assess all the costs. They've looked at competitors and so on. And so saying I'm too busy, I hope that we can learn and teach to view that as a confession, not an excuse, not a justification for not doing something. It's a confession of, I'm not handling my schedule very well. I've said yes to too many things. I haven't put limits. Remember, back to boundaries. I haven't put limits on my physical ability and the time constraints that I have. Setting aside an hour or 2 hours per week to do your family budget, to do your business bookkeeping, should be something that is considered pretty sacred, that I don't violate those 2 hours with anything, because my goal is to help this business, God's business, He's the owner, I'm the manager, to help it flourish. I need to take that time. So, but to do that, to develop a discipline is not easy, right? How many days does it take to create a new habit, whether it's a good habit or a bad habit? Some people say 31 days, 30 days, some people say 21 days, but it's something that it takes time to do. You're not going to decide today to be disciplined in this and have it happen. And so our recommendation is that people begin bookkeeping the very next day that they take this class, so that by the time they come back next week, they have 7 days now, and you get to encourage them. And that's why we go from the windows, the pricing, we don't go on to marketing. We want to go right to the roof, because we want to have them with us for another 4 or 5 weeks to make sure that they are getting this, and we can encourage them continue to do their bookkeeping. And the example, the activity I like to do with people is take your hands and fold them, all right? And so if everybody does that, you interlock your fingers, most of us will have either our left hand on top, or if we fold our fingers a different way, our right thumb will be on top. Now, my left thumb is always on top. When I change all of my fingers interlocking so that my left thumb is on top, it feels uncomfortable. It doesn't feel good. So I can't see you, but I hope that you're doing this as well. And I want to go back to the way it feels comfortable. This is the way I always fold my hands. It feels comfortable, but this is part of the discipline. The discipline in doing bookkeeping is that it feels uncomfortable, and we have to fight this desire to get back to the way it feels right, to what we're used to doing. And so we have to learn to live with that discomfort and remind ourselves that in time it will become like a good habit, like brushing your teeth at night, or telling your children that you love them. It's something that you begin to do as a habit, because it's been ingrained in who we are. And so for learning the discipline of bookkeeping, we have to recognize that it's going to take some accountability. And I recommend that we develop accountability relationships. Not that you're showing necessarily, if that's too vulnerable, to show your budget or to show your numbers, but somebody should be asking you and be able to receive the honest answer from you. Have you been keeping your records? And are you assessing what those records actually mean? So the financial planning process is very simple. It's plan, do, review. Plan, do, review. The planning is where we set a budget, where we expect that we will be spending a certain amount on our stock or our inventory. We will need certain supplies to run the business. We will need to spend a certain amount on our employees' salaries, and so on. So we need to set our budget, and then how much do we expect to have in sales? But we have to remember from session 5, when we did boundaries, then we look at the budget. We have to remember that budget is just an idea. It's our best guess of what it's going to be like. We then have to implement. So now is the doing. And that is where we begin keeping records of what is actually coming in and what money is actually going out. And so often I try to emphasize to people, that's all we're doing. That's all bookkeeping is what is coming in and what is going out. And then being able to add that up, or be able to have somebody else add that up for us. But we have to track it so that we can then do the most important part, in my opinion, which is review. And unfortunately, it's the part that people do the least. A lot of times people do planning, not always. Many people do keep some records of money coming in and going out. But if we don't review, if we're not interpreting what is being recorded, then it's just keeping us busy. It's not actually achieving the goal that we want it to achieve. And so we have to review. I said that we would spend X amount on transport for this month, and yet we spent this amount, that much higher. Why was that? Was it because I was wrong in my estimate? Was it because we did more travel than what we had expected? Was it because the cost of petrol went up? The reviewing part is when you look at those variances and you try to decide, was the budget wrong, or was I wrong in how we managed our finances? And so the reviewing part takes us back then to the planning. If we have to make changes in the budget, or if we have to make changes in how we do things, then that's important. The example I love to give when we do budgets is my late husband and I set our budget for finances for groceries, for food in our house for the month. We said, this is what we want to spend. Then we started going through the month and we spent money on food, and it came to about the third weekend, he wanted to buy food, and I said, I'm sorry, but I've been reviewing how we're doing and we've spent it all. The money for food is finished for the month. And so then we had to look again to say, were we wrong with the number that we had, or was our behavior wrong during the first 2.5 weeks of that month? We decided our behavior was wrong. So we didn't put more money. We just stayed tight for the last part of that month. And the next month we were more careful. And so that's what the reviewing does. It takes you back to do some corrective action if you need to. So plan, do, review. Those 3 things are critical for us to do. Bookkeeping is, this is where you can review what is actually bookkeeping. It's about organizing and storing the financial information and then preparing the statements. And sometimes you will work with businesses that are big enough to have a bookkeeper. And that's great. They need to understand as managers and as owners that bookkeeping is a portion of what the entire accounting equation is, all right? It's the financial information infrastructure of the entity. It needs to have some internal controls, though, that the owner needs to be aware of to help keep that bookkeeping process pure. Accounting is the broader system, right? It is what defines the bookkeeping system. It is what establishes the controls to make sure that everything's working well. Accountants usually set up the system, and the bookkeepers are the ones that follow the systems. But these internal controls that protect people from the temptations of stealing, the temptations of using their time, less than stewardly way for the business, all sorts of different things are not just there to protect the profit of the business, but it's there to protect the employee from falling into temptation. And that brings us back to another side of the stewardship, that when we do bookkeeping, it is stewardship of our resources, it's stewardship of our time, it's stewardship and protection of the employees, and then it's also the stewardship for our customers, because we have put into place the structures that will protect them and allow them to have the best price and the best quality as well. All right, and so we want to take a look at financial accounting versus management accounting. And again, this is for those business owners who maybe have somebody who's helping them, or maybe you're a pastor and you have a treasurer. We need to understand the difference. We're not trying to make everybody accountants, but some of us are going to have to learn to do accounting, bookkeeping, and some of us are going to have to not only learn that, but we will have to learn how to interpret it. So on the left-hand side, you see financial accounting. So in the finance office, or when we're talking about bookkeeping, we're talking about recording transactions, classifying transactions. Was that part of transport? Was that part of our inventory? Was that part of supplies? How do we classify in our various columns that we might have for transactions? We need to reconcile the records. We brought in this amount, we spent this amount, we should have this amount left. If we don't, what happened? Did we not bring as much in as we thought? Did we have some expenses that we forgot to account for? That reconciling is important to make sure that we have the full picture, so that we can really feel good about the information that we are taking from our reports. We then summarize those transactions over the course of a month. This is what we did. And then we present the financial data, all right? And so that's all the financial accounting side. And so some of us need to be able to do all of those things. But all of us, if we're business owners, need to do the other side, the management accounting. And that is where we take that financial data, those reports, and we compare those results against the goals. In session 4, you did your goals, and some of you had economic goals. All of you, I think, had economic goals. We asked you to come up with goals according to the quadruple bottom line. And so we now have to look at, okay, this was my goal. How did I do? Did I achieve that goal? Did I fall short? Because the next step then is when you compare the results against the goals, you have to determine the reasons for the variance. If I fell short, was it because the budget was wrong, or was it because the activity was wrong? And that is only something that you as a manager or as the owner are able to do. What are the reasons for the variance? Once you determine the reasons, then you can identify the corrective action, and then you go back into your planning again. Now that we have this corrective action, what is the new plan, or does it stay the same? And the plan is for us to somehow have better internal controls. So for some people, some of those, the planning is we need to look at our books more often. Once a month is not enough. We need to do it every week. We need to get more details, or whatever it is that your corrective action is going to be, and then you go back into the planning again. And so again, this is time where you are going to sit with each other when you're teaching this, to have a discussion of the difference of these two. If we are not presenting the financial data, if all we are doing is recording transactions, then there's really not a lot that's going to give us. It's not going to give us anything that we can make educated financial decisions from. And so you can see the process that needs to be done here for us to be stewards of God's business for which we are managers, excuse me. All right, there's 3 main activities when it comes to accounting. So we need to identify what are the economic events that we need to be recording. Those may be obvious, right? But sometimes they're not as obvious. Then how do we do the recording? That's where we want to spend our time because we need to record, we need to classify, we need to summarize. And then we have the communication parts, the preparing of the accounting reports. And so session 7 for trainers, session 7, we're looking at the recording part. What do we need to record? How can we classify? How can we make that easy? And then be able to summarize it. Session 8 is where we're looking at the reports, where we can make an income statement and a balance sheet. Oftentimes, micro businesses are going to simply do the recording part. And so we will walk them through a process where they know they have a structure that they can record, classify, and summarize. And you can still get good information from that. It's the SMEs that are going to need to do those accounting reports for the income statement and the balance sheet. And so again, when we teach the micro business sessions, it's 6 of the 12 that we have for the SMEs. So we don't teach income statement and balance sheets for the micros. But for the SMEs, we want to be able to do both. So as I said, the 2 main financial documents that we look at in session 8 is the income statement. Some people call it a profit and loss statement. Some people call it a P&L. And that is relating to the activity of the business, where we look now for the course of the month and we say, okay, this is how much income came in over the course of the month. This is how much we spent on these different things. How did we do? How much profit did we actually make? The balance sheet relates to the business value. How much is the business worth in total? It provides information on assets, on liabilities, and owner's equity. And we will talk about what those terms mean in just a minute. But we want to point people towards in session 7, that session 8 is tied closely to it. What we do in session 7, the recording, the summarizing, the classifying, gets transferred to these documents in session 8. But this is where if I have accountants in the class, I'll ask them to plug their ears and just remind us that there's no official right way to organize your books. Now, accountants would say that that's not true. But the idea is we want to say you need to start with something. Start by, and I've seen so many systems. Everywhere I go and I talk to business people, you can see a slightly different system. But it's basically 2 main things that we're tracking: money coming in, money going out. As your business grows, that system will become more sophisticated. You will be forced to if you want to see your business grow, and your business can grow when you can make educated decisions about what is actually happening in terms of the finances. But we want to, again, our goal we said is to help reassure people. We want to say, do these things and you're already halfway to a decent accounting system. These 4 things, all right? If you start with this and let people know, it doesn't even require any math. Just start doing this, because then you can have somebody else do the math if you need to. First one, if you buy something, but you don't need to pay for it right away, get an invoice, okay? And then you have a box or you have a bag and it says invoices on it, and you put the invoice in there. When you pay cash for something, get a receipt. Again, you have another box or another bag and you put your receipts in there. Make sure that they're dated. If you sell something and you don't receive the money for it, make an invoice. Okay, and then lastly, if you receive a payment, somebody pays you for something, give a receipt. Now, how can we say that if by doing these 4 things, you're already on your way to a decent bookkeeping system? It's because what we're doing is we're organizing a paper trail, a trail that's going to be able to help us, you know, if I'm too busy and I'm tired or I had a bad day, I can go to the box and say, okay, invoices, what do I owe? All right, now I can look at all the invoices. Who do I owe? When I paid cash, where did my expenses go? What happened to the money? I can track it through those receipts. If I sell something, what do people owe me? That should be money that's coming in. It's money that I'm owed. I can pull out the box of invoices, and we would say that would be accounts receivable, money I hope to receive. Who owes me money? And lastly, if I want to be able to know how much income I brought in, I can look at the receipts of those that paid me. That's 4 simple things to do. Now, simple meaning it's simple in structure. It takes time, right? It takes time to issue an invoice or to issue a receipt. But time is something that we can say, we can prioritize how our time ends up being used. And once we decide that this is a priority, that our owner is demanding this new system, this owner is putting in this internal control to help us to be better stewards, then we don't get to just say, well, you know, I didn't get to it. But we begin to change the language that this isn't our business, this is God's business. And He has a desire for me to do what I'm doing, to be a blessing to more people, to flourish, to be a blessing to my customers and my employees. And in order to do that, I need to do these 4 things. And yes, it's going to take time, but I'm going to cut out this and that or whatever in order to make that a priority. What you will see in your participants manual, when you flip through, you are going to see what I have on the screen right now, this money management cash journal. And you will actually see 4 of those, because our goal, our desire, especially for those who are doing a smaller business, but it depends on the business. If they're not doing anything, they can start with this. And our desire is for them to start tomorrow. And we really want to emphasize that. Beginning tomorrow, there's no excuse. You've got the system here. You've agreed that it's important. And we want you to do this for 4 weeks. And that's why we have 4 of these in the participant manual. So they can make copies of that. But our goal is to do this. This is a sheet that will record the transactions and automatically classify the transactions, and then can give the summaries as well. It's a simple worksheet. I often tell people if they're doing something already and it's working for them, they don't need to switch to this. That's okay. But if they're not using anything, this is one option. And so at the top, you want to start with what is the working capital that you have. And so in the very first top line there, you want them to look at how much money do I have right now? How much money does the business have right now? So I'm looking at the bank, you know, what does the business have? I'm looking at what I have, you know, in the business money, in the business itself, or maybe I have money in a SACO. How much is the capital, the cash that the business has? And then starting tomorrow, I'm going to start recording every day how much income comes in. If I sell furniture, it's very easy. I can even put a description. I sold a bed, I brought in this amount. I sold a table and chairs, I brought in this amount. If I own a kiosk or a duka, something that has many transactions, I can just classify at the end of the day. I started the day with this amount. By the end of the day, I had this amount. I have this much in income. All right, but every day of the week for the next 7 days, you're going to record how much money came in sales. All right, and so that becomes the income portion. The next box down below is the cash that went out. And this has to do with the variable costs, which we started talking about in session 6. How much money did you spend on your stock or your inventory? How much did you spend on supplies that you needed for the business? What are the things that that you spent relating to your sales? And remember, that's the variable cost, what the customer takes away with them. And so as you buy your stock or your inventory, you record that in that second box there. And that, again, helps to classify that. The next box on the same page in your workbook is then cash that goes out for the fixed costs. And normally we pay fixed costs once a month, not every day usually, so there's not as many lines there in a week. But that is, what did we pay for salary? What did we pay for rent? What did we pay for electricity? What did we pay for transport if that's not part of the variable cost? And so we list out there what we paid for the fixed costs. And then the last box is the cash that went out for other things, not variable costs and not fixed costs. Well, what are the other things? Well, if I buy a piece of equipment, it's not a variable cost and it's not a fixed cost. It's actually an investment in the business. It's an asset. It's a fixed asset. If I spend money on things that are not variable costs or fixed costs, I write them down in that last category. All right, and so our goal by the end of the week is now we need to total up how much did we pay out for variable costs? How much did we pay out for our fixed costs? And so what we want to then be able to do is to add up what is the working capital that you had, that you started the week with. How much money did you start the week with? Add to that how much income you had come in. And then you subtract out what you wrote in boxes 2, boxes 3, and boxes 4. All right, and so now you have an idea of the cash that's available. Now, for those of you who are into accounting, what we are teaching in this case is a cash system. Okay, we are only talking about actual cash that came in and actual cash that went out. We are not talking about an accrual system, which we will talk about when we get to the accounting, the basic accounting formula. And so now from the bottom of the page where we came up with our subtotal of cash available, we now go back to the top and we write at the top the total amount that we have of cash that is available. Because now our goal is to get people to spend on paper, to make decisions of where this money is going to go. The biggest problem that I see in many businesses is that we end of the week, we feel good about the money that's in our pockets because we haven't separated the money from ourselves, the business from ourselves. And what we need to recognize is if we don't make a decision for where that money is going to go, circumstances, the community, life will make those decisions for us. And so the recommendation is that you look at how much cash you have available, and now you make a decision. What do I need for working capital for this next week? What am I going to need to pay for both variable costs and fixed costs for this next week? I have a loan payment that's coming up in 3 weeks, maybe. I need to put one portion of that payment aside. Owner's draw, how much do I get to take? I put myself on a salary. I didn't have a good week. I really can't take as much as I would normally like to take. Or we did really well this week. Last week I couldn't take as much as I needed in terms of my salary that I decided. This week I'm going to make up for that. Business goals and reinvestment. Remember, this is where we make those decisions about the profit. How much am I going to put back in the business? And how am I going to do that in order to achieve the goal? Maybe it needs to go into a savings for emergency savings. Maybe I want to give some as a gift or as a tithe of some sort. But the idea is that you get to that leftover cash with zero remaining. You have to spend it on paper. This is the cash that I have now. I'm going to put this much towards my working capital, this much towards my next loan payment. This much is what I'm going to take for myself, this much for my goals, this much for my savings, and this much for a gift, and that's it. I'm down to zero. If you still have money remaining, it's going to leak out and you won't be able to account for it. So make a decision if you need to add another category, whatever you need to do. But the whole idea with a budget is that you are allocating everything and helping to control it so that you don't become a victim of circumstances of people, again, the boundaries, right? The limits that we've set. We make those decisions as a manager of the business that God has given us. And so that is the goal, is to come up with a zero at the end of our leftover cash. And so we want people to start doing this, but we also want to recognize that in a cash system, there are transactions that take place that don't actually see cash until sometime later. And so we call those the accounts receivable and accounts payable. The accounts receivable, that's money that I expect to receive. Okay, this is an asset. This is a good thing. It means I've done something for a customer and the customer said, I'll pay you later. Many, many businesses, we talked about this in session 6, believe that they have to take that. They have to give people credit, but then they have a hard time following up on it. And they end up with a huge amount of money that is owed to them and no chance of recovering it. And that just becomes a loss. And that is not good stewardship for the business. You may be helping somebody out for a day, but if you're out of business in a month, your family is suffering, your employees are suffering, and the community has lost that business that can help it flourish as well. So keeping track of those non-cash transactions, people that owe you money, is important. And having a policy for how they do that is also important. The next one then is the accounts payable. And that is the money that you owe to somebody. So you said to somebody, I'm going to take these goods and I'll pay you for it at the end of this month. And so you also want to keep track of that. That's a non-cash transaction. And you want to be able to keep track of what you owe. So accounts receivable, money you hope to receive. Account payable, that's money that you have to pay out. And so we want to help our participants to recognize in this cash system, there are non-cash transactions that happen. And so this is a way in this book that they can keep track of those as well and be able to see. For some people, they're surprised how much they give out on credit. I remember working with one business that had a huge accounts receivable. They had been keeping track of it, but they had absolutely no hope of recovering the majority of it. And so it made their balance sheet look good. It made it look like they had more assets than what they actually had. But because they didn't have due diligence for how to recover that money, they had to just take it as a loss. And so those are things that we need to consider. The basic accounting equation. Okay, so that brings us to the end of the simple bookkeeping worksheet. And if you're doing a business and you aren't doing this as a trainer, I would encourage you to start tomorrow. Start using something like this. If not this form, then a different form that works for you. But start to keep track of money coming in and money going out. If you again in your class that you're teaching, you feel like this is about the limit of what people can take in, then you stop at this point. But assuming that you're talking to SMEs and we want to bring them to a little bit of a higher level in terms of a more complex accounting system, we want to talk about this basic accounting equation. And as trainers, I think that it's important that you have this basic understanding of this accounting equation. And the accounting equation says this: assets equal liabilities plus owner's equity. Assets, here you see a formula, has to equal your liabilities plus your owner's equity. This is actually just a very beautiful statement, and I'm not an accountant, and so I've learned to appreciate this over time. Basically what we're saying is you have assets in your business. Every single person that has a business has some sort of assets. There's only two ways to explain that those assets came to the business, either through a liability, meaning I took a loan, and so I owe somebody that, or through owner's equity. And owner's equity is a more complex, we'll break that down, but those are the only ways that I have assets in my business. I can only explain it through those two ways. And so this is the underlying framework for understanding economic events. All right, assets are either claimed by the owners, or if you have a loan and you have a beautiful looking stock and inventory, but you owe money, then the creditors can claim that asset. All right, and so let's look further into what assets are and what liabilities are and what owner's equity is. And what you will see is that session 8, we do a repeating of this because we want to repeat this information from sessions 6, 7, and 8. There's some repetition because people need to hear this more than once, especially, and I can't see you all, I can't see your faces. Some of you may have tuned out, and so we're hoping to catch you on a time when you're tuned in. But we do need to understand the basic accounting equation. So assets are resources that the business owns. So what do you have? And it can be the cash that you have. It can be the supplies that you have, meaning the things that you have that help you run your business. It can be the equipment that you have. It can be the furniture that you have. It can be the vehicles that you have, the machines that you have. It can be the building that you have. It can be the land that the business owns. All right, and so assets are current assets, meaning things that we can turn into cash quickly, or they are fixed assets, things that like a building or land that we don't usually turn into cash very quickly. All right, and so those are some descriptions of assets. Liabilities are the claims against the assets. So if you took a mortgage or you took a long-term loan and you signed a loan agreement, that is a claim that somebody can make against the assets that you have, okay? So it's money that we owe to different creditors. Some of us have long-term loans, meaning we signed an agreement and we are only required to pay that amount every month. They can't come and claim the whole thing unless we haven't been paying according to the agreement. But some of us also take things that we would call are part of accounts payable, meaning that it's less than 30 days. So we don't sign a loan agreement. We may have an invoice and we make an agreement to pay by the end of the month. Or we owe people their salary. It's the 15th of the month. We pay them at the end of the month. We have a liability of 2 weeks of pay that we owe to a particular person on a particular day. Okay, most people understand liabilities. The last one then is the owner's equity. And his owner's equity is, what does the owner get to claim of the assets? And the owner can claim everything of the assets except what is owed to the creditors, the liabilities. Owner's equity comes in two different ways. It comes in by the owner's capital, what the owner actually contributes to the business in terms of capital. But it also comes in by the income minus the expenses, right? So when you make a sale and you have a profit, that profit becomes part of the owner's equity. And so we're going to look a little more closely at that. And so here we have a bit of an expanded equation for the owner's equity. We have assets equals liabilities plus owner's equity. But for the owner's equity, there's 4 main categories that come in. It's the owner's capital, the money the owner puts into the business, minus what the owner takes out for themselves. So minus the owner's drawing. So when you take a salary, it's considered the owner's draw. Remember, we talked about that last week. So the owner's capital goes in, the owner's draw is subtracted from that, but the revenue is something that comes into owner's equity, but we also have to subtract out the expenses. So when we look at the owner's equity, it's those 4 categories together. That's what gives us the owner's equity. So revenue, of course, comes as a result of business activities, sales, fees, services, commissions, interest, and so on. Expenses, as we've talked about, are our fixed expenses and our variable costs. That's the cost of assets consumed or services used in the process of earning the revenue. So common expenses are salaries, rent, utilities, taxes, and so on. What we want to do when you're in class, and we won't take the time to do this right now, is to look at the accounting equation, and we ask this question. Are the following events recorded in accounting records? Remember, we said that there's 3 things. There's identification of an economic event, there's the recording, and then there's the communication of that. And so we want to ask this question. Did the financial position of the company change when supplies are purchased on account? And by saying on account, we mean that we took it on credit. So we want to ask the class, is the financial position of the company changed when supplies are purchased on account? Is that a yes or a no? And what we often find is people will say, yes, it changed. And so the question you want to then ask is how? What changed? Well, suddenly you have supplies, right? And supplies are an asset. They have a value to it. It's something that you have in your possession that has value. It's an asset. How do you explain that you have this asset? Well, you explain it because it's a liability. So remember, assets equals liability plus owner's equity. This particular asset came as a result of a liability. It's something that we have to pay for yet. So it's an asset that we have, but the creditor has a stake in that. They will come and take those supplies back if I don't pay the money for it. Okay, so an economic event occurred even though money did not change hands. So this is the difference between a cash system and an accrual system. In a cash system, we would not record this as an economic event because no cash changed hands. When we paid the person, then we would record it. In an accrual system, you record it when the event took place, not when the cash changed hands. So this is an economic event in the double entry bookkeeping system because your assets increased. And the way you explained it is now you have this liability. All right, the second question. An employee is hired. How do we explain that? Did an economic event take place? A lot of times people will say, yes, and I will ask them, what changed? Assets, liabilities, or owner's equity? And they will say, an asset. They have an employee now. But we don't actually own the employee. And so the employee is not an asset of the business. There was actually no economic event that took place because we just hired them. We haven't paid them yet. And so at the end of the month, when we pay them their salary, If we pay them cash, our cash asset will go down. And now we will have an expense for the owner's equity that we will record as an expense. The third question we want to ask is the owner withdraws cash for personal use. Did the financial position of the company change? And again, we say yes, they took cash out. So our cash went down. And now we explain that it's not a liability. We didn't take a loan. It's not capital. We didn't put money in. It's the drawings. We took it out. And so we record it under the owner's equity. What I want to do is I want to actually have people unmute themselves. I was debating how to do this, and I think because of time, I do want us to go through this activity, but I want you to be able to raise your hand, and I'm going to ask maybe Dr. Walker to help call on people for that. Just to go through this, because going through it as a group is actually, I find, helpful. I would encourage you to practice this, to go through it until you really understand it. There are some people that are going to get this immediately, and for others it will take some time. It's often a lot of words until you go through this. And so when you are training, and you're going to go wade into these waters, I encourage you to do this example as a group, because you will see light bulbs going on. And usually I would say I see light bulbs going on with maybe a half to a third only. And those are the ones who are going to be able to step their bookkeeping system up to this level. For the others, it's okay. They don't have to get this, but it will make their accounting life much easier if they can. So let's go through this example together. Ray Neal decides to open a computer programming service, which he names SoftBite. On September 1, 2012, Ray Neal invests $15,000 cash into the business. Okay, so Ray opens a business. He is going to start with a capital of $15,000, his own money. So where do we record that? What changes in the business? If somebody can, Isaac, go ahead.
It's the owner's capital.
Okay, so the
owner's capital.
Yeah, owner's
and the
capital,
cash.
15,000. What else changes, Isaac?
Cash. Cash
Very
also
good.
changes.
All right. So we can see here that cash goes up 15,000. Okay. And how do we explain that cash? Really, that's the question we're asking. How do we explain that we have 15,000 in cash right now? Owner's capital. That's how we explain that asset. The owner made an investment of 15,000. All right. The next one, we have a purchase of equipment for cash. So Ray buys equipment. He purchases $7,000 of computer equipment, and he pays cash for it. So how do we account for that? What changes in assets, liabilities, or owner's equity? Alex, I see you unmuted.
Yes, I am, but I haven't picked it yet.
Okay.
Isaac has his hand raised.
Yeah, when he purchases the equipment, we put it under equipment.
Yeah.
So equipment changes, and then also the cash reduces.
All right, very good. And so what I didn't explain to you, thank you, Isaac, is that the assets in this case have been broken down into 4 columns. And every business may have different number of columns depending on the type of business. In this case, SoftBite is not a stock or inventory. He's not selling things, he's selling a service. And so he has 4 columns for his assets. He has his cash, he has the accounts receivable, that's the money that customers owe him. He has supplies that he needs to run his business. So my guess is he has printing paper and toner, ink for the copier and so on. And he has equipment, and in this case, he has computer equipment. Okay, so he has 4 different assets that he wants to track. Other businesses might have 8 or 3 or whatever. He only has one thing under accounts payable. So that tells us that he hasn't taken a loan, and he's not planning on it at this point. And then under owner's equity, we have those standard 4 categories: owner's capital minus owner's drawing, plus the revenue that comes in, minus the expenses. So as Isaac said, he purchased this equipment. So equipment goes up 7,000, okay? But cash goes down 7,000 because he paid cash for those computers. What you see in this transaction is that the asset just changed its form. There was no financial numerical change overall in the business. We just had the asset of cash change into equipment. All right, so cash goes down 7, but equipment goes up 7,000. All right, somebody beside Isaac now. Transaction 3, SoftBite purchases for $1,600 from the Acme Supply Company computer paper and other supplies that are expected to last the business for several months. The purchase is made on account, on credit. Okay, so SoftBite goes out, they say, I need computer paper, I need a toner for the printer, I need all these pens and other things, $1,600 in supplies, and he says, I'll pay you later. I'm not going to pay for it right now, I'll pay you later. What changes in the business? Elvis Nokason, go ahead.
Okay, you wash the others and I'll wash the others.
Okay, Tay has his hand up.
All right, could I try? Alex?
Yes, go ahead.
Hello. I think that his supply will go up by that amount. I've forgotten the amount of money.
1,600.
1,600. But then, since he did not pay cash, that will be entered under his liability.
Excellent, excellent. So, yes, now he has supplies. So in his business, you walk into his business, you'll see all this computer paper and toner and pens and all sorts of office supplies. And you say, how can you explain, where did that come from? Well, it came from a liability. Now he owes money. So it's entered there under the liabilities. So excellent. All right, transaction number 4. SoftBite receives 1,200 cash from customers for the programming services that it has provided. Okay, 1,200. So it does a piece of work now. It does some computer programming, and a customer pays them cash, 1,200. How do we explain this in terms of assets, liabilities, and owner's equity? Theo, I see your hand up.
Over there, I see that cash. Sorry, we are in a room here. Then we have a lot of. Now over there, I see that there is a reception of cash. Then the cash will go up with 1,200.
Yes.
And then there's also increase in revenue.
Excellent.
Yes.
Thank you. So yes, cash goes up 1,200 because we have cash. How do we explain this cash? Where did this cash come from? It's a revenue. It was a sale that was done. And so it was a service that was done. And so we explain that through revenue. What you're beginning to see here is what brings fear to many people, this double entry accounting. But it's not that confusing, because we're simply asking, where did the asset come from? How do you explain this asset? And it can be explained in one of 2 ways, either a liability or owner's equity. And remembering owner's equity has these different categories, but that's really what we want to be looking at. All right, number 5. SoftBite does some advertising in a newspaper, and they receive a bill for $250 from the Daily News for advertising, but they don't pay it right away. So they received the bill and they said, I'll get to that later. How do we explain, how do we write this into our transaction analysis? Anybody have a hand up? Emmanuel, Kanya, you want to try?
Yeah, I think that goes into liabilities and the accounts what? That goes into liabilities.
Yeah.
Because it's money to be paid.
But what are we paying for? What is it that we got with that liability?
Well, it's an expense, I think.
Excellent. Yep, it's
Yeah.
an expense. So it's
Yeah.
it's an advertising expense. It's something that we have to do in terms of our marketing for the business, and so we account for it by it being an expense, but we're not paying for it yet. So it becomes a liability, and it goes into that category. Very good. Thank you. All right, transaction 6. SoftBite provides $3,500 of programming services for customers. The company receives cash of $1,500 from the customers, and it bills the balance of $2,000 on credit. Okay, so they do $3,500 worth of work. The customer says, I'll pay you $1,500 now, and I'll pay you the rest, the $2,000, I'll pay you later. How do we put this into a transaction?
Okay.
Williams.
Let me try. 1,500 goes to cash.
Yes.
And then $2,000 goes to account receivable.
Receivable. And 3,500 goes to revenue.
Yeah. Yes.
All right, and Yvonne came in on it. 3,500 goes to revenue.
Oh, sorry.
All right, so what you can see here is we have 3 different numbers recorded because the 3,500 was broken into two categories. It was cash that we received, but we also, they said they'd pay the rest later, so we have to say the accounts receivable, we hope to receive the 2,000 in cash. So how do we explain this 1,500 plus the 2,000 that we've recorded in the accounts receivable? Well, we had a revenue. We did a service for somebody and that they're going to pay for. Good. All right, next, SoftBite pays the following expense in cash for September. They paid store rent in the amount of $600, salary of employees in the amount of $900, and utilities in the amount of $200. So how do we explain this transaction? Somebody who hasn't spoken yet.
Nicholas.
Johnson, go ahead. Yeah, I'm not hearing you.
Hello.
Go ahead.
You can hear me?
Yes, I can hear you now.
Okay. With the expenses, the cash will reduce, and the individual expenditure accounts will go up.
Okay. So we have cash reducing for our rent by $600, and we account for that in the expenses, right? We pay our rent, $600. Same with the salaries of employees. Our cash goes down $900. Where do we explain that money went? It went to as an expense to our salaries. And then last, our cash goes down $200 for our utilities. How do we explain where that money went? It went to the utilities for $200. Good, thank you. All right, transaction, SoftBite pays the bill now that it received in transaction 5 for the advertising done in the newspaper. So now they said, okay, that's right, I owe the Daily News $250, I need to pay that. How do we explain this transaction? Somebody who hasn't spoken. Kaden. Go ahead.
Okay. My camera is not working I'm sorry for that. So let me try it. In the cash place, we're going to write the 250, the 250. And then in the account payable, in the liability, we're gonna write the 250.
Excellent, good. And this one often tricks people because people will often say, well, it was for advertising, so it's an expense. But we already put it in the expense category. We don't want to put it in there twice, making it look like we spent 500 on advertising. And so we need to decrease the liability. We've paid off that liability by 250 and cash goes down by 250. Excellent. All right, transaction number 9. SoftBite received 600 in cash from customers who had been billed for services in transaction 6. So if you remember, they owe 2,000. They said they would pay us later, and now they come in and they pay 600 of the amount that they owe. How do we record this transaction?
Fred.
Yeah, the cash will go up by $600.
Good.
Cash will go up. Cash goes, because SoftBite received $600, so cash goes up.
Yes. What else?
And then the accounts receivable.
Excellent.
It's going to be the 250.
The
Yeah.
600, right? Right, so very good. So the cash goes up 600 because we've received cash. How do we explain this cash? Well, it was from the accounts receivable. So accounts receivable goes down because now they owe 2,000 minus that 600. That's how we explain that cash. All right, the last transaction. Ray Neal withdraws 1,300 in cash from the business for his personal use. So Ray says it's the end of the month. I need to take some money for myself. And Daniel from Ethiopia, how do we explain this transaction?
I think from the cash where someone is withdrawing the cash.
Good.
So it's considered, I think, will decrease from the asset.
Yes.
So also in owner's equity, we'll also withdraw the same amount of money. So we have to decrease from that also.
Good. Which part of owner's equity, Daniel?
Sorry?
Which part of owner's equity? Is it owner's capital, owner's draw, revenue, or expenses?
Owner's drawing.
Excellent. Good. So yeah, so Ray takes 1,300. That cash goes down 1,300. How do we explain that? Where did that cash go? Well, the owner took a drawing of 1,300. And so that is how we explain that. And so this is 10 different transactions. And just as we did it now with different people contributing, I would recommend that you do this so that people begin to see, not that they become an expert in the equation, but they begin to see how it works, how it is that this equation of any asset I have, I need to ask, where did it come from? Either a liability or the owner's equity. And here is what I believe is beautiful. When you add up all of your columns, so now you take your cash column and you add 15,000 minus 7,000 plus 1,200 and so on, you get 8,050 in cash. Accounts receivable, we had 2,000 that was owed, they paid 600, we are left remaining with 1,400 in what people owe us. Supplies, we have the supplies, we didn't consume them. Sometimes we have to look at how much we consumed and we decrease that amount as an expense, but for now we have 1,600 in supplies. We still have 7,000 in the equipment. At some point we'll depreciate that, but not right now. The accounts payable, we owed 1,600 and we owed 250. We paid off the 250, we're left with owing 1,600. We have the owner's capital that we started with of 15,000. We have what the owner took out, a total of 1,300. We have a total amount of revenue that came in the amount of 1,200 plus 3,500 for a total revenue of 4,500. And then we have expenses. The expenses were the advertising for 250, the rent for 600, the salaries for 900, the utilities for 200, a total amount of expenses in the 1,950. And here is what's beautiful. When we add up our assets, it has to equal our liabilities plus owner's equity. And so when we add up our assets, we see that those four columns together give us $18,050. When we add up our liabilities and our owner's equity, we come up with the same total, $18,050. If you don't balance, if you can't reconcile those two, then there was an error somewhere that you can go back and correct. But essentially, this is what gives you your income statement and your balance sheet. So session 8 is where we look at the income statement and the balance sheet. And what I like to do with this example is to show people, if you can get used to this system of doing your recording, it's going to become much easier for you to then do your income statement and your balance sheet. Because the income statement essentially is those last two columns, the revenue minus the expenses. So he had revenue of $4,700. He had expenses of $1,950. We see that overall he made about $2,750. That was his overall profit after paying his variable and his fixed costs. But how would you say, I want a few people. Oops, well, that's beautiful, Isaac, but right now I'm going to be the one sharing my screen. Let me get back here. So what would you say? I would like for maybe 2 or 3 people, maybe those who haven't gone through this training before, for sure. How did this business do? As a trainer, if you were going to look at this spreadsheet of transaction analysis for the first month that this person was in business, what would you say to Ray about how his business performed? What can you assess out of this spreadsheet, this analysis? A couple people to comment.
Alex.
You spoke before, but I see you unmuted. I'm looking for other people to unmute as well. Let's make sure that as many as that can participate do so. All right, if not, then Fred, go ahead.
There's Josh.
Josh, go ahead. All right. Josh.
All right. According to, I see Ray injected in a capital of $15,000 at first, and then we are ending up after the month is having $1850. So I'm seeing the business is doing well. There is a little profit there. That is what I mean.
Okay. All right. Fred, what would you add to that?
I see a profit of around 3,050. So he got some profit in this business, though he had a lot of expenses.
Okay.
Some expenses, yeah, but there's some profit.
What you need to be careful for is you use the word profit. He shows an increase in assets of 3,050, but 1,600 of that is a liability, right? It's money that somebody else can claim. So it's not quite profit yet, but he did well. He ended up higher, and we certainly could say in terms of his profit for income minus expenses, you can see about 2,700 or something there. Good. Anybody else? Something? Ben?
Yeah, I would say that he has just broken even.
Okay. And even breaking even for the first month, they often say for the first couple of years, it's difficult. You know, if you're breaking even, you're doing well, because you often have to spend a lot more to get your name out there, to get the sales out there. And so even if he would just broken even, then he would be doing better. So this is really, on this spreadsheet, you can see the income statement, which is the revenue minus the expenses, but you can also see the balance sheet. And the balance sheet, which we will cover in just a minute, goes through our assets, our liabilities, and owner's equity, and everything in the balance sheet is on this page. Emmanuel, did you have a question or a comment?
Yeah, I would say that what I see is that he managed his liabilities well at the beginning to help him manage his cost of running the business, which was good.
Yes. Yep. I might caution him about his owner's draw. It's a kind of a big owner's draw to take. It's a lot of the profit that he actually made. But still, you know, that's his freedom to do that. Isaac, did you want to add something yet?
No, I just wanted to find out how often do I use this transaction analysis? Is it on a daily basis that I record it, or once a week?
Well, so again, this is up to you how you set the system, and it depends on your business. What he did was every time there was a transaction is when he recorded it. So it would be on a daily basis, but you're not going to do the summary until the bottom. So every day you're looking at, you know, the cash that came in and you're entering it in as a revenue or an expense. You're looking at money that you spent and you're entering it as an expense or an accounts payable or you know, so it's something that you do as you are experiencing these economic transactions. If you do it on a weekly basis, you would have to just make sure that you're organized enough to be keeping those receipts and those invoices so that you can do that as you see fit. So it depends on the business. It depends on the structure that you have set up and your ability to keep track of things. The recommendation is for most that we do something small on a daily basis so that our reconciling on a weekly basis doesn't have to take as long. And often when we do it every day, it's fresher, it's more fresh in our minds. And then that means that, like, my recommendation is that you take a 2-hour block in a week where that's uninterruptible time. And that's when you go through and you make some of these summary statements so that you can make some decisions from it. But if you do just a little bit every day, it will help you to not have to take so much time at the end of the week. All right, what I want to do is review our quiz 7 together. And I'm going to share a different screen because this is both of the quizzes I want to take a look at. Let me see here. Are you able to see this quiz? Quiz 7?
Yes.
Okay.
Yes.
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 I want to run through these.
We are able.
Okay. I want to run through these questions quickly. Why are bookkeeping records important to our business? And the options that I gave you was A, to analyze past business performance and make changes to improve importance. That was should have been performance, sorry. To help you monitor, B, to help you monitor and evaluate if you are making or losing money. And C, for legal and regulatory reasons. And then D was A and B, and E was all of the above. And so what was the correct answer in this?
It was E.
E, very good.
It was all of the above.
Good. So bookkeeping records are important for so many different reasons. Good. What is the recommended financial planning process? Budget, spend, save, plan, do, review, or spend, review, modify?
Plan, do, review.
Plan, do, review.
Plan, do, review. Plan, do, review.
Plan, do, review. All right, next one. Bookkeeping refers to accumulating, organizing, storing, and accessing financial information, or the controls set up to detect and defer theft and embezzlement, or the entire financial system, including the internal controls and verification of recorded information. What does bookkeeping refer to?
Accumulating,
Organizing,
financial
organizing,
storing,
controls
and
financial information. Good. I heard most people saying accumulating, organizing, storing, and accessing financial information.
Accumulating, organizing, storing, accessing financial information.
Yes, it's about taking all of that financial information and organizing it. That's bookkeeping. What about accounting?
We lost you.
Refer to? The same three options. Oops. The same three options. Anybody? What does accounting refer to?
The third one.
The entire financial system, including the internal control and verification of recurring information and data.
Very good. All right, I'm hearing many people saying the last one. And yeah, so accounting is the bigger system, and that's as managers what we need to be embracing as well. All right, true or false? Management accounting includes comparing results against goals. Is that true or is that false?
True.
True.
True. True.
All right, very good. True. All right, we want to take the results and we want to say, how did we do compared to the goals that we set? The next one, management includes, accounting includes classifying transactions. Is that true or false?
False. It's false.
False.
Good, right? That's what our the bookkeeper will be doing, is classifying the transactions. As managers, you need to be looking at the bigger picture, not specific. Good. The basic accounting equation is what?
Asset equals to liability plus owner bookkeeping.
Okay. I think I heard asset equals equity. Good.
The last. Assets equals liabilities plus owner's bookkeeping.
Good. And the last one, owner's equity includes which of the following categories? What does owner's equity include? Remember, we said there was 4. Somebody give me go ahead and shout them out.
Revenue.
Revenue.
Liability.
No. Owner's draw.
Revenue, expenses, owner's draw,
Capital.
owner's capital.
Expenses.
All right, revenue, expenses, owner's
Expenses, owner's draw, owner's capital.
And that's good. And I know that, you know, watching it once and then going on is a challenge. But I'm going to jump now right into our session 8. So that's good. I see that everybody's doing well with the quizzes, and you're writing me if something doesn't make sense, or if I make a mistake on the quiz, you're letting me know, and I appreciate that too. So let's keep going now here. And Emmanuel, did you have a question?
Yes. In a situation where the owner takes the salary and he has the discipline of not making regular drawings from the business, is it okay not to put it under the owner's equity and put it under the salaries, where you put the salaries, since the owner is being paid the salary like any other work of the business? Is that okay to move that into the salary column and not put it in the owner's equity?
Right. So you're asking, if I am disciplined and I just take the salary as the owner, can I put it under expenses as opposed to putting it under owner's draw? Yeah. So I think that accountants would argue with you to say there's no need to do that. You can put it under owner's draw. But I would say if you're a small business owner and that's what you want to do, that's okay. The only thing that you need to remember is that when you treat it like it's a fixed cost, you may think that you are entitled to it. And if your business isn't doing well, that's why we separated out the owner's draw, is to make sure that we are remembering as owners that it's not a fixed cost. I'm not entitled to my salary. If the business doesn't do well, I shouldn't take that salary.
Oh, great.
So I think it's okay to do that. I don't know, you know, why you would not want to put it under owner's draw, except maybe that you don't want to reveal what it is you're taking. But no, I'm not in a bad way, but I mean, some of that enters into that as well. So I think, again, if you are working with an accountant, they will argue with you that you do it that way. But I think if you're doing this on your own, it's just good to keep recording at one place or the other is okay. And that's where I get accountants. So All right, session 8 now. So now we're going, and we're just going to go right into this. Again, every class that we teach, every session, we want to make sure that we're doing devotions relating to doing our business as a mission, doing our work as an act of worship. And in this case, we're looking at Hebrews about how discipline is painful when we do it, but it does produce this harvest of righteousness and peace. When you start managing your money, whether it's your personal money in your family or your business, there is a peace that comes. I guarantee it. I've seen it, I've heard it, I've watched it over and over again. When we don't manage our money, there is a fear, an underlying fear that keeps us from sleeping at night because we know that a bill is coming, we haven't planned for it, we aren't prepared for it, and we end up suffering. And so this is an important point to reinforce when we are doing this class. I have some discussion. Session 8, our objectives are to understand the value of being able to understand financial reports on the financial position of the business. Again, if you want to manage your business, you have to have knowledge about what is happening financially. If you don't know, if you are guessing, it's going to have a negative impact on the business. So in this session, we want to know how to make the reports. How do we make an income statement? How do we make a balance sheet? We want to reinforce key concepts from session 7. And then when you're teaching this session, you want to have practice time in small groups. And so in this activity, in this session, in your book and in the PowerPoint, there are practice activities. And you have 3 hours for this session when you're teaching it. Really encourage you to make sure that they have time to get together and do more activities like what we just did to reinforce what the words that they're hearing. Again, a lot of these words for people, it's going to go over their head or it's going to go in one ear and out the other, but getting people to practice is going to be important. So we're still working on the roof. We want to be able to review. So remember that at the end of session 7, you told everyone, go and start this tomorrow. And next week, I'm going to ask you what you did. And I'm going to call on you and say, did you start? Because when you let people know that you're helping to hold them accountable, it's a motivation for them to do it. And what gets you into the habit is accountability. Let me just share. I just finished a 3-week, I went to 3 different sessions on teaching about fundraising. And the fact, they said that they normally do it in 1 session. And the fact that they broke it into 3 sessions, and I knew that I was going to have to go back. And this is a small enough group that they would say to me, Renita, what have you done since last week? Boy, that motivated me. I didn't want to say, well, sorry, I was busy, right? Because busy means I didn't manage my time. And so that's the same thing that you want to do. You want to say, I'm expecting you all to start this tomorrow, and next week I'm going to ask you, what did you do with it? And that's one of the reasons why we make sure that these sessions are done weekly, that we don't do it all in 3 days or in 1 week, but we do it over 12 weeks so that people get out there and they practice it. And they come back and they are accountable for it. And they can talk about challenges and problems that they have. And you get to coach them through that. So the reviewing part, again, is very important. All right, income statement and balance sheet. So the 2 things that we want people to come away with. An income statement is a report that shows the results of a business's operations in terms of revenue, expenses, and net income over a period of time. So an income statement is normally done over the period of a month. You might have an income statement that you do at the end of the year for the whole year, but normally we do those on a monthly basis. The items recorded in the weekly money management worksheet will build into the income statement. So once they do 4 of these, 4 of these, you add those 4 together, and that's going to give you 1 month worth. And so that's what we want the participants to start doing, recording regularly. And after they have a month worth of those transactions, they can then put them into an income statement. So it reflects a period of time, right? Not a point in time. The balance sheet reflects a point in time. And I'll talk more about that in just a second. Revenue, I'm not going to go through that. Again, we're repeating what happened last session. So I'm not going to go through what is revenue, what is net income, what are expenses. That's all part of this. We talk about net sales, cost of sales. We're repeating now things from session 6 and session 7. Gross profit, operating expenses, all of these things, fixed costs. You want to take the time when you're teaching to review these, but because we just went over this a few minutes ago and this is a TOT, we're not going to do that. So now here we come to an example of an income statement. And the income statement is taking our revenue that we looked at for SoftBite, the example we looked at, as well as the expenses. And so at the top of our sheet, we put the name of the business. This is an income statement for SoftBite, let's say, for the period of, and this is where we're reminded that an income statement takes place over a period of time. And so we would say from August 1st until August 31st, or whatever month you're having to do. And then you add up in, let me go back to this worksheet. In the worksheet that you had, the first box was the cash in section. And so you want to add up, how much cash did I get the first week, the second week, the third week, the fourth week? That becomes my total revenue. Some of our businesses have service revenue, meaning let's say I have a salon and I cut hair. So that's a service revenue. But let's say I also have a sales revenue. I'm selling hair or I'm selling hair products. And so I have other sales revenue, and then there might be other revenue as well that you might have, dividends or whatnot. And so you add up your total revenue for that period of time that you listed at the top of the paper. And then you start going through your variable expenses or your cost of goods sold. So you might have, that's listed in the second box, your variable expenses. What purchases did you make for the materials that you have for your inventory or your stock? Did you have to pay shipping or transportation for that income, that inventory or that stock? This is where you list wages that are paid on commission. So if you have people working for you and you're paying them on commission, that's where you list that in the variable expenses, meaning that you are paying people based on the sales that they do. So if they're on salary, it doesn't go there. And then other costs relating to variable expenses. And then you come up with your total cost of sales. Now you take your total sales and you subtract out the total cost of your sales. That's going to give you your gross profit. All right, the second half of your income statement is now looking at your fixed expenses. What did you pay for, or what do you want to put aside for depreciation? Did you have an insurance payment? Did you have to pay interest on a loan, your supplies, and all these other things? Many of us don't have a lot of these expenses. Just get rid of them. You don't need to have all of these lines here with zeros. Just make your income statement for the lines that you actually use. And so again, this is where on this cash sheet that you're working with, or that they may be working with, this is where you find the income, as I said, the variable cost, the fixed cost, and you can transfer those now to your income statement. All right, so here's an example of an income statement. This is a PW Audio Supply Company, and this is an income statement for the entire year. So they are looking at their total revenue for the whole year. Sales revenue was $480,000. They had some returns that they did and allowances. They gave some discounts out over the course of the year. So that reduces their total sales revenue by $20,000, gives them their net sales of $460,000. All right, and so then they had, what were their variable expenses? The cost of goods sold was $316,000. That's what they spent over the course of the year. Gives them a gross profit now of $144,000. How was that $144,000 used? Well, they had to pay all of their fixed costs or their operating expenses. And so we see salaries, utilities, advertising, depreciation expense, the freight out, the shipping, insurance, and so on. they had total fixed costs of $114,000, and that left them a net profit now of $30,000. All right, and so this is what your income statement can show you, and this is why it's such a valuable tool, because it can tell you from month to month, but it can also tell you over the course of the year of how you are doing in these various areas. And if you remember last week, I mentioned many of us doing business, we know our variable costs, but we don't factor in all of the operating costs. And so oftentimes we're running our business at a deficit because we're not accounting for everything. And that's not, I mean, it's not a good thing, but it doesn't mean we need to get rid of the business. It means that we need to look more carefully at one of the three ways to increase our profit. All right, raise the expense, raise sales, or decrease our expenses. Did I say raise price? So those are things that we need to be aware of and we need to be able to make good decisions for. So that's an example of an income statement. So the income statement is, as I said, done monthly. The balance sheet is recommended that you do it annually. If you can do it more often, for example, I recommend if you don't have a very complex business with many, many different products, that you do it on a monthly basis, because it gives you the whole picture of your business overall. So let's look a little bit more closely. The income statement, what's the difference between these? The relationship, the income statement summarizes the results of an operating period. Those results end up being reflected on the balance sheet, right? Because it's part of the owner's equity. The balance sheet is a reflection of the net worth or value of your business. This information is based on assets, liabilities, and owner's equity. The balance sheet is essentially that equation that we talked about in session 7. Assets equals liabilities plus owner's equity. So you're looking at what I call it is it's a cumulative photograph of your business, from basically showing it from the start up until today. You're explaining how did you get the assets that you have and how can you explain those assets. So it's a snapshot, and so you do it at a point in time. So if you do a balance sheet, you say today is August 20, Thursday, August 20, I'm going to do my balance sheet today. How much cash do I have? How much do I have that people owe me? How much do I have in liabilities? How much revenue have I had? And the reason you do it at a point in time is because tomorrow you have some sales and the situation has changed. Somebody pays off something that they owe you, you make a payment, and so on. So the balance sheet is done at a point in time, whereas the income statement is done over a period of time. And so to help us understand, again, we have the standard classifications as listed at the bottom of the screen here. You have your assets. Those are your current assets. Those are your long-term investments. That's your property, your plant, your equipment, and the different, whether it's current assets or whether it's fixed assets, all right? And then on the other side, you have liabilities and owner's equity. So the liabilities that you owe, and then the owner's equity, which you may have stockholders, but it's your owner's capital minus the drawings plus the revenue minus the expenses is what gives you the owner's equity. And those two sides have to balance out. That's what makes it a balance sheet. Assets have to equal your liabilities and your owner's equity. All right, so again, current assets. We talked about that in just the previous session, so I'm not going to go through all of that. One thing that I would say, though, that I didn't mention for current assets, cash, accounts receivable, your inventory, one thing we forget about is our prepaids are also an asset, a current asset. Example, if you live in Ghana, you pay your rent far in advance. That is an asset. You have a prepaid rent that you paid for 2 years maybe, and you're only in month 6. You have 18 months still of prepaid, that's an asset. The scratch cards in your phones. Maybe you just loaded your phone up and then you're doing the balance sheet the next day. That's an asset that you have. It's a prepaid that you have. Insurance that we have is often prepaid. We pay for the next year. And so when you're looking at your balance sheet, you want to account for all the assets that you have. And so if you paid for a full year's worth of insurance and you're only 2 months in, you have 10 months still that you get to claim as an asset that the business owns. Okay, so that's something else to think about when you're talking about your current assets. Your fixed assets, of course, are your equipment, your land, and your building. And then on the balance sheet is now where we enter in depreciation. So on the income statement, all we show is income, money that came in, revenue, and expenses. We don't show any assets. We don't talk about if we buy a computer, it doesn't show up on the income statement. If we buy a vehicle for the business, it doesn't show up there. It shows up on the balance sheet. That's where we look at all of the assets and all of the liabilities. That's where our accounts receivable shows up. And that's why a lot of people forget about people who owe them money because they're not doing balance sheets. They're not keeping track of those non-cash transactions. But the balance sheet is where we say, okay, I bought these computers, like for SoftBite, for $7,000. But the reality is, as soon as you buy something, it goes from new to used, and it immediately loses value. And so we need to allow for that depreciation. And so as we said, when we talked about this last week on session 6, everything depreciates except for land. And so we use that formula of the price, what we paid for it, divided by the duration. And so this is a case where if you buy these computers, and people estimate these days that computers last 24 to 36 months, let's say we say 36 months, we bought the computer 3 months ago, we need to depreciate it, 7,000, I forget how many computers he bought, divided by 36 months, gives us our monthly depreciation. We need to depreciate it by 3 months because we don't want to say that we have $7,000 worth of computers when we've already, they're used now, we've used them for 3 months, they're probably only valued at, you know, 6,700 maybe. And so that is where you list that out, is on the balance sheet. All right, current liabilities, accounts payable. And some of accounts payable are also the people that we owe money to. So, I mean, not just outside of our business, but even the salaries that need to be paid. Again, a balance sheet is done at a point in time. If I do it on Thursday, August 20, I owe 20 days worth of salary to my employees. I owe 20 days to the electrical company for the electricity the business has used, and things like that. We need to think of all of the people that we owe for the current liabilities. Long-term liabilities, that's going to be more obvious, the notes that you've actually signed. Okay, owner's net worth, we review. What is the owner's capital? What is the owner's draw? What is the owner's net worth? Now, a lot of people will not have any idea how much money they've taken from the business since it began, right? The owner's draw. A lot of people will have forgotten how much capital they put in. Maybe they didn't track the fact that they weren't pulling all they had the initial capital that they put in, but they weren't pulling all the profit out maybe. They weren't keeping track of all the revenue and the expenses. So the way to get through that is very simply to reverse this formula. And so down at the bottom, you can see that the way to find out the owner's equity is by taking the assets and subtracting the liabilities. That's the easiest way to do it. I have this much in assets, pretty easy for people to figure that out. I have this much in liabilities, pretty easy for people to figure that out. Now we'll know what the owner's equity is. And from here, we can begin tracking how much of that is owner's draw, how much of that is revenue and expenses. But for most people, they haven't been keeping records. So this is how we get them started today so that they can do their balance sheet. So here is a balance sheet that we have in your manual. And again, you'll see the name of the business at the top. And now it says as of a specific date. It's not a range. That's the income statement. The balance sheet is done on a specific date. And then you have the current assets on the left: cash, accounts receivable, inventory, supplies, prepaid. And again, you may have people that need to take some of those out and you want to add in equipment or other things like that. Although we have equipment down below. land, under fixed assets, we have land, buildings, equipment, furniture, and fixtures, and then we subtract out the depreciation. And so we add up our total current assets and our total fixed assets minus the depreciation, and that's where we get our total assets there in C1. On the top, on the right side, you see the liabilities. Accounts payable, what do I owe people for goods that I've taken? Accrued payable, these are the accrued payable is the salary that I owe, the electrical bill that I owe. I haven't received a bill yet. I'm not late on paying salaries, but I know that the business still owes that as of this particular day. Then you have your short-term notes and your long-term notes. You add up your total liabilities, and then you add in your owner's net worth, which is your capital, subtracting out your draw, and then your net income, which is your revenue minus expenses. Again, if you have no idea what that is, you simply take your total assets, you subtract out your liabilities, and you put that in your total, your owner's equity, your net worth. Now, one of the things as as trainers, I want you to notice is that each of these has A1, A2, A3. Okay, cash is A1, accounts receivable is A2. We wanted to make this as simple as possible. And so what we have in the manual, as you go through these different pages, you will see that they will have various different questions that they can work through. And as they answer the questions, they are being told where to put that amount. So here it says cash. How much cash does the business have on hand and in the bank, or in a SUSU, a savings club, etc.? You put that amount in A1. So if I'm going through this and I'm thinking a balance sheet seems overwhelming, I want to break it down into bite-sized pieces for people. How much cash do you have? Well, that I can figure out. Okay, let me look. I've got this amount. I go to A1, and then I enter it in where it says cash and where it says A1. Then I go to the next question. How much do customers owe the business for completed work? And this is where I would encourage people to be realistic. People that owe you from 8 years ago and you don't know where they live or anything about them anymore, that you don't get to count those on your balance sheet. They have to be a realistic amount that you're able to actually recover. Inventory, what is the cost of the inventory that you have on hand? This is, you now need to, and this is why balance sheets are done often once a year, because for me to go through all of my inventory and add up what I paid for it can take a lot of time. If you are in pharmacy, that's a lot. If you are having a provision shop, that's a lot. But you need to take the time to do that at least once in a year, where you go through and say, what do I actually have? What does the business actually have? And then you put that into A3. And so on. Supplies, what is the value of the supplies that you have? Supplies is not inventory. Supplies are what I need to run the business, but not something that the customer takes away. That's my stock or my inventory. Supplies is what do I have? All the things that I need to run the business, how much do I have? Prepaid expenses, your total current assets. And so you go through each of these. What was the purchase price for the land that the business owns, if the business owns land? What was the purchase price for the buildings bought by the business? What was the purchase price for the equipment? And then furniture and fixtures. And then you need to enter in the depreciation. And so we talked about that. We're not going to go through that again. And so all of this, a lot of session 8 is walking them through that. Now, the other thing you need to know is that we have this on an Excel document, and I'll put that on under session 8 today. I'll put the Excel document that asks these questions, and when you fill it in, it will automatically put it on the balance sheet for you. We have a lot of these things in Excel. If you yourself use Excel, or you have students that use Excel, you can share that with them as well. And so the net income, this is again to figure out the owner's equity. Again, I just would recommend that you go through your assets minus your liability to come up with the owner's equity. So this is the example that we used from session 7 in SoftBite. If you remember, we looked at the bottom of that time period that Ray Neal was tracking his transactions. He had $18,050 for both the assets as well as the liabilities and owner's equity. And so what does that look like for his income statement and his balance sheet? And so what you can see here at the bottom of the screen is his balance sheet. And so you can see cash. How much did he have in cash? We can go back and we can see that the cash column had $8,050. So he put in cash $8,050. Accounts receivable was $1,400. Supplies was $1,600. Equipment was $7,000 for total assets of $18,050. And then he figured out his liabilities was the $1,600 that he owed for the supplies that he took. And then we figured out the owner's capital by looking above. We have the total capital of $15,000 that he invested. We have the total income, so revenue minus expenses. The net income of $2,750 gives him a total of $17,750. But then he took $1,300 out, and that gives him a total now of $16,450. So for owner's capital, that's what's entered in. That plus the liability gives him the same $18,050. Now you can see that this balance sheet is set up with assets and then underneath liabilities and owner's equity. The way we have it in our book is we have them side by side. It doesn't matter how you do it, but they do have to balance. Assets always has to equal liabilities and owner's equity. So now what you see are a number of different examples. And again, I would strongly recommend that you run through these examples yourself. I thought about assigning them, but you have the trainer's manual, so you have all the answers as well. Try to do it without looking at the answers. If you're like me, when my daughter was in high school and I was tutoring her through some of her math, I had to see the answers and be able to work my way back to say, okay, how did they get that answer? Let me try to figure that out. So you could do that as well, but the remainder of this session is when you're teaching it, is to be spent on doing these activities. And you can see all the answers are entered in there. And then you prepare an income statement based on that activity, as well as a balance sheet. So those are things that you can work through yourself. Recommend that if you don't use it, you lose it. Here's another example. I obviously have entered these in line by line, which takes time to click through, except when you're teaching, you want it to be that way. But I want us to, see, what are we doing with time? Good, we have a few minutes. I want to put us into small groups, and I want you just to be able to articulate to each other. I'm going to give you 8 minutes or so to talk about what is the difference between an income statement and a balance sheet, because you need to verbalize it in order for it to get into your brain better. And then as you have time, discuss what is the difference between current and fixed assets, short-term and long-term liabilities, and then what is owner's equity? How would you explain to somebody owner's equity? Revenue, expenses, owner's capital, and owner's draw. So I'm going to stop sharing, and I'm going to send you into your groups, your breakout rooms. And that's what I would like to have you do, is I will copy and paste those instructions to your breakout rooms, but take a few minutes to explain to each other, what is an income statement? What is a balance sheet? What are these various terms? And be able to give everybody a chance to say something about that, because that will help get it into the brain better as well. So here I go, I'm going to send you on your way. So many of you are not. All right, you should all be in a room now or going to a room.
I did not see the room to which I was allocated, Alex.
Okay, Alex, you are in room 2, breakout room 2. I just cut and paste this question.
Hi, Renita. Hi, Dr. Phil.
Hi, Emmeline. Welcome back.
Emmeline, did you have a
Thank
nice
you.
time? Did you have a good time?
I did. I learned a few things.
Oh, good. Your day is
I learned
complete.
a few things. I'm going to practice it next time I'm hosting or co-hosting the meeting. I'm going to practice some of them.
Maybe for a year, recommended.
Yeah.
Maybe what assets you're important in the business.
Right, I'm just writing the messages to them real quick.
Yes, that's what I say in the past.
Let's see, he's not there. All right. Yeah, so you're going to share with us, or I think they sent the link as well, but are you gonna summarize it in an email, Emily, what you learned? Pause this recording. So I hope you had some good discussion, had a chance to speak the words. The last thing I want to do for today is to still go over the quiz from session 8. So those of you who haven't taken it, you're getting a chance to hear some of the answers. But I realized for these 2 sessions, we want to make sure that we're understanding what we are doing. So again, we'll do the same format as we did for the session 7 quiz. You can just unmute and tell me the answer. What is an income statement? The first option, it's a financial report that shows a business's operations in terms of revenues, expenses, and net income over a period of time. It's a good thing I read it out loud. I see another mistake there, typo. Second, it is a statement that shows the assets, liabilities, and owner's equity at a point in time, or it is a statement that shows the cash flow for a business on a daily basis. So which is the right answer? First, second, or third?
First.
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 Good. So it shows over a period of time the revenue and the expenses. Good. What about a balance sheet? Is it the first, second, or third? Same 3 options.
Second.
Good.
Second, yeah.
It shows the assets, the liabilities, and owner's equity at a point in time. All right, what are the current assets? Which of those listed there are current assets?
Madam, you have disabled the business.
Cash.
We have cash and inventory.
Cash.
Cash and inventory.
Account payable.
Hearing? Yes.
An inventory.
Revenue.
Inventory. I have a remark to make, please. Yesterday, I put cash and inventory when doing the quiz. I was deducted. I had 0 points because equipment was included, but I think equipment is part of fixed assets. But in the quiz that was given online, they included equipment as a current asset.
I haven't gone to make correction. That Google is not
equipment.
No, equipment is a fixed asset.
Yes, equipment is a fixed asset. But
yes.
I did a quiz yesterday, but I was given 0 points because I didn't put equipment as a current asset. I checked cash and inventory, which I think are correct.
Right. So I will,
Yeah,
I will be
that's what
going through
happened
those
to
and
me.
correcting the ones that Google did not give you credit.
Actually, I will have to help us there because that's the same thing which happened to me.
Yes.
We're not hearing
Me
you.
as
again.
well.
And
Equipment.
equipment, I will give you points if you put it for that, even though mostly it's a fixed asset, but definitely not accounts payable and not revenue for that. All right, what's the formula for gross profit?
Is gross profit is equal to net sales minus
Net
cost of
sales minus cost of goods sold.
Right, because that's very good. Because the gross profit is before we take out our expenses. Okay, after we take the expenses out, then we have the net profit. All right, what are some examples of fixed assets?
Land and building.
Land.
And building.
Building.
All right, now questions I really wanted to get
Land,
to.
building.
Yes.
All right, Peter is a car salesman. He sells a car for $10,000 cash. What changes in the basic accounting equation? Let's just have one person this time. Raise your hand.
Assets.
Peter, the cash will go up and revenue also will go up.
Revenue up.
All right.
Goes up.
Good.
Cash and revenue. Cash and revenue.
How do we explain the
Goes
cash?
up.
It's a revenue. It's a sale. Very good.
Yeah.
Cash goes up, revenue goes up. Next one. If patient takes office supplies on credit in the amount of $500 and agrees to pay the bill in the next 30 days, what changes in the basic accounting equation?
Supplies goes up as well as
Supplies and liability.
Liabilities go up.
Excellent. Good. Supplies go up and liabilities goes up, right? So she agrees to pay it later. Good.
Yep.
Well done. Give yourself a hand. I think you're getting it. Those of you who are not,
thank you.
and appreciate your attention to this. These are the tougher classes to get through. Tomorrow, we will be doing marketing. Together we'll be Caroline Sudi from Kenya will be teaching us marketing session 2. Of course, very important as well for how we attract people into our business. We'll be moving back now, installing our doors and our windows. So keep watching the videos, keep taking the quizzes. Email me if you have any challenges. I will be getting those the video out and the PowerPoints out today. And let me ask, who do we all have on here right now? Let me ask Yvonne, would you close us in prayer for today? Yvonne Mildred and Ghana?
Yes. Yep, I'll be happy to do that.
All right, thank you.
Heavenly Father, we thank you that you are the owner of us and of your world. We thank you for the abilities you give to people to teach us and the abilities you give to us to understand. Father, I pray that as we study more for tomorrow and do other things, Lord, I pray that you will bless the work of our hands and particularly our hearts. And I pray that you give our trainers refreshment in Jesus' precious name. Amen.
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 God bless one and all.
Amen.
Good day.
That is voice of a little angel. Amen. Bye-bye.
Amen.
Good night.
God bless you all.
Yes.
Okay, we're leaving.
Bye-bye.
Moses, amen.
Bye-bye.
It is already
Bye-bye.
Ciao. Bye-bye. Bye.
Bye.
Bye-bye. Bye-bye.
All right, have a good day.
Bye.
Bye.
Batson, bye.
Bye.
All right, Dr.
Bye.
Gary.
Bye.
What is